So this slide is just setting out some of the key KPIs around health and safety. Probably the important thing on the slide, two things. One is we had, as William indicated on the capital expenditure, we had a relatively low level of project involvement going on in the last financial year. So activity levels down slightly. Overall the results were pretty good, but probably two things I'd just draw. A lot of effort that's gone on by the management team, particularly through Fraser and Mark in improving operating procedures. There are two incidents during the year that gave us concern. One was a gas burn, or a burn rather, suffered by one of our operators operating a customer's coal boiler. And there's some procedural things around that gave us some insight into some improvements that could be made, and also some of the issues associated with dealing with another owner's plant. And the second was a near miss that we had, where a crane driver drove onto one of the geothermal fields that we operate, and nearly smacked into an 11 kV overhead line. It was a near miss, but procedurally it's something that shouldn't have happened. So they're probably just a couple of indicators that there is a real focus across the company, as there is indeed right across this whole industry, on improving safety performance. So this gets into a bit more of a discussive stuff. In terms of looking forward, I guess we see the forward market at the moment around electricity demand as still being relatively benign, although there is growth at the consumer level, which is largely related to population, migration and those sort of things. At the industrial and large commercial level, we really aren't seeing any growth, and that's not surprising when the levels of investment in those sectors is, I guess, stagnant. Withstanding that, as I said earlier, we are seeing geothermal in particular displacing coal and gas. And I think we're seeing quite a lot of market plant changes across the sector. The RO gas storage is a significant change in the market, something that I think we have talked about for a couple of years as Contact's been developing that as something that will have an influence on the market, together with their reduction in take or pay quantities. We're also seeing decisions being taken to retire some of the old inefficient coal plant at Huntly, I think in 2013 and 2014. And those things will have a dynamic in the market. You know, we've seen this before. The market takes a while to adjust to changes in plant mix. Takes a while for investments to occur and then manifest themselves in the market, and only then do you see the competitor response. And if you look at the overall market, the Huntly units are the only remaining old gas technology that was around when the market really started flying post-97. So it's just a part of that, as I would see it, as part of that maturation of changing market or changing plant mix in response to the dynamics of a market, rather than the central plan that occurred when some of that technology was built. In terms of geothermal developments beyond Ngāta Mariki, we see a couple of sources for those. One is greenfield and the other are brownfield developments on some of the reservoirs we're operating on. But we do see the greenfields as being more expensive, and we also see the whole profile of geothermal developments being slower than what we've had or driven over the last 5 years or so. They will be more expensive because they will tend to have more risk and probably be of smaller scale. So their average cost will be higher than the benefits we've had out of the so-called Tier 1 sites both Contact and Mighty Rivers had the benefit from. In terms of wind options, we are progressing Puketoi, and Mark, is it 3 years that we've been in looking to get a consent out of Turitea? Pretty close to getting a consent after 3 years on Turitea, which just underpins how long it takes, and therefore the need to actually start early and get these projects to a point where you've got a consent and an option you can exercise. That's not to say the market conditions will support the option being exercised once you've got it. We certainly see them as being potential medium-term growth, but we would need to see recovery in electricity demand or electricity demand growth from where we are today. On the retail, I've talked some about this. We definitely are seeing quite a different complex in the retail market than what we would have all seen 5 years ago, where it was, you had 5 or 6 brands and all selling the same product to residential. It's much more differentiated now. You've got we're using multiple brands, targeting different niches within the overall market segment. A lot more activity below the line, so headline prices don't necessarily tell you a lot. And so, very dynamic market. From our perspective, we've always looked at multiple channels to market. So, some of you recall, CFD market was something we drove in the middle of the last decade. Got good growth out of that. Then we saw a market or competitor response to that, and we've tended to have a reduction in those CFD sales. We jumped into residential in 2009 ahead of the geothermal expansion at Ngāo and then this last year has been much more competitive. It's been more a case of us trying to hold on to those volumes. At the moment, we see a large number of larger customers sitting on spot, and we've seen that happen before through the different cycles in the wholesale market. We expect that condition will change again in the future as well. And partly that's driven by some of the changes in the market mix that I was referring to earlier on. So as William said, we are now operating with a higher base in our operating portfolio with the addition of baseload geothermal, together with the firm production we've got out of hydro. But we do have a significant flex to operate at higher levels above that if market conditions suit. And so there's an optionality around the exercise of Southdown that William's talked about. And we've also entered into a swaption contract with Genesis, which allows us to call on capacity from them, particularly in conditions where we might want to firm up the amount of capacity we've got available on our portfolio. So it's a multi-year contract, and otherwise called in the jargon a little bit like a dry year support contract. So a lot of optionality in the portfolio, which is a combination of the type of plant we've got and the business model that we run. Ngā Tamariki, just to point out where it is, the way I think about it is if you're driving from Taupo to Rotorua, it's on the left before you get to Ohaki on the right. So that nuclear power station looking thing, that is the cooling tower at Ohaki. Right across the road from that is the Ngā Tamariki field, and the site that we're looking to develop the power station on is in the middle of a currently forested area. It's a $466 million investment, as William said. The initial development is 82 megawatts. It's using AUMAT technology, which is it's actually 4 by 20 odd megawatts, and has the potential for additional modules to be added to that. Drilling's due to start in the next month or so, using a new technology rig supplied by Iceland Drilling. I think it's coming across the wharf at the moment, or has come across the wharf. So it's good to see a more efficient and high-tech drilling rig into the country, which we also think has got much better potential performance on health and safety. And as I said earlier, Ngā Tamariki due to commission mid-2013 and contribute to earnings from FY14. Just talking about international geothermal, probably some of this you will have seen before. Probably just a bit of an update on a couple of things. One, the Hudson Ranch project. So this is a 49.9 megawatt plant using the same technology, Fuji technology, as at Kawerau and Ngāupura. It is well advanced in construction. The plant's up on its pedestal in Southern California, due for mechanical completion around the end of the year and commissioning through the early part of 2012. A key thing with the Hudson project and renewables development in the US. It is underpinned by a long-term offtake contract, a PPA, written with a utility in Arizona. And the existence of that PPA and tax equity financing arrangements at the Fed level in the US means that critical issues that we'll be working through at Hudson Ranch, or will be worked through at Hudson Ranch in 2012, are the sale of the tax equity in the project and the refinancing the debt post-commissioning. And that will generate cash flows for the project, and it's part of the structure of our investment through GGE in that project, that those two elements will start to drive the returns back to the GGE fund. At the end of June, we had 160 million deployed. Circa 100 million of that is in the Hudson Ranch project. The rest is split across Chile and Germany. In Chile, the main thing that we're focused on at the moment is fuel resource proving on the Tolhuaca site in southern Chile. We've had slower progress on that. They've had a massive snowstorm, or the worst winter in 20 odd years, not the worst winter, biggest snowfall in the last 20 odd years, which has delayed some of the drilling on the first resource proving well. But we are expecting to see the results of that exploration activity off the back of summer 2012. And that will give us the best read on the prospects for further investment on Tolhuaca. We're progressing other permits, Puchildiza in particular, in northern Chile, in the Atacama Desert. And in Germany, we've worked through 3D seismic work on the Weilheim prospect south of Munich, and looking at other concessions in the German area. I guess the big thing that's happened in Germany in the last 3 odd months is the German government's passed a significant increase in the feed-in tariff that applies to geothermal, partly as a result of the decisions they've taken around nuclear post-Fukushima. So the geothermal opportunities in Germany are looking more attractive than when we first committed to Germany. So just on a sort of looking forward, it's not an outlook as in the sense of a financial outlook, but as William said, the Standard & Poor's did put us back on BBB plus stable, but with a bit of a nudge to say you don't really have the ability to fund further development beyond Ngā Tamariki and the GGE 250 million commitment inside the next couple of years. And if you do, we'll reconsider your rating. So essentially a strong signal that without equity capital, we wouldn't be able to advance further projects, either domestically, which we weren't interested in doing, or internationally, without some threat to that credit rating. Those financial metrics do improve, obviously, post completion of Ngā Tamariki. So your capital outflows decline, and you start to get earnings contribution from Ngā Tamariki. But for the next couple of years, we are relatively constrained in our current structure. If I look at the geothermal stuff offshore, we're not constrained by opportunities. There are more opportunities you can shake a stick at. It's a matter of trying to be selective and given our capital constraints, try and target the ones that offer the best returns. As I say, domestically, it's a low growth environment. We would see any investment being out beyond the FY13 in any case. I think as a business, we have, if I go back 5 or 6 years ago, where we didn't have a whole lot of options, firm options around a development pipeline, we were looking at a number of different channels to get to growth. And now that we've actually advanced geothermal and seen the benefits out of that, we've really started to concentrate on geothermal as the key point of difference for the company, not just domestically but also in a global environment, and shut down some of the other options that we had looked at, exited the upstream gas as a place, and pushed wind back in terms of development potential here in New Zealand. So in summary, earnings for this last year significantly enhanced on prior year, but underlying that is quite an increase in the base earnings that the company can deliver even in weak conditions. because of that firmness in the generation side of the business that wasn't there or not at the same level 5 or 6 years ago. Strong retail performance, holding on to sales. You would have seen on one of the graphs, I think Williams, prices across the fixed price market up 7.7% year on year, and maintain volumes there or thereabout over the year. It will be challenged keeping hold of that and in the go forward, but good work focusing on the quality and keeping downward pressure on operating costs. TSR, total return on the capital, 11.4%. I think an excellent result, particularly when you put alongside the compound growth in EBITDAF over the last 5 years. And as I say, the biggest problem we've got in international geothermal is we're not opportunity constrained. Not a bad problem to have. And in conclusion, really trying to focus on where we see our competitive strengths and looking for sustaining growth out of those points of difference. All right, I'll call that a wrap. Thanks a lot.